This is our November 2023 market view. Argent differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof. Connect with us on social media. So what is the conclusion this month? A seasonally weak time of year is turning into a seasonally strong type of year for the stock market. Economic indicators favor a soft landing scenario over a hard landing scenario. And investors may be in a win-win situation. So I'm pretty optimistic. Let's look at stock market returns. Returns were strong through about the first half of the year, and then starting in August, we've had a correction in the S&P close to 10%, and in small cap close to 20%. So is this seasonal weakness, or is it something more? Well, you can see that seasonality would imply it's seasonal weakness. The fall is usually the worst time of year, and the end of year, November, December, tend to be the two best months of the year. So it is not atypical to see a seasonal weak fall after a strong start to the year. In fact, when we have seen a strong start to the year, when the S&P is up over 10% through July 31st and then down in August, historically going back to 1938, 100% in those scenarios, 100% of the time, the stock market is positive from the end of August through 12/31. If that was going to be the case, and we would hit the average return of about 10% from the end of August through the end of the year in these scenarios, the S&P 500 would need to rally about 14 percentage points from here on 11/6/2023. Now let's look at unemployment. The unemployment rate has ticked up to 3.9%, and non-farm payrolls in October only increased 150,000. It was below the consensus, but we still got information about productivity, which jumped 2.24% year over year, and that's the fastest pace in 2 years. When there's more productivity, labor costs go down, and those fell to 1.87% year over year. A slowing job market with more productivity and lower labor costs means Fed policy is working, and that's what the market wants to see. Investors want to see that Fed policy is working so that they do not have to raise rates more than they have already raised them. Despite Fed policy working, the labor market is still pretty strong. There are still 1.5 times the amount of job openings per unemployed. So this unique combination of rising unemployment, lower wages, but demand for labor implies a soft landing where the Fed lowers inflation without a recession. And that looks more likely than a hard landing. To back this up, we see credit conditions that, despite higher interest rates, the availability of credit to businesses and consumers is favorable. If you're creditworthy, you can get a loan to grow. Typically, we see credit conditions fall pretty precipitously before a recession. We just are not seeing that. And the consumption is about 70% of GDP in the US. Consumer balance sheets remain healthy despite the rise in interest rates. This means it is more likely consumers can withstand higher interest rates. We look at Ned Davis's inflation model, which consists of 22 different indicators that measure the various rates of change, such as commodities and consumer prices, producer prices, and industrial production, and you can see it's in its disinflationary zone, where inflation falls about 1 percentage point per annum. So inflation is still coming down, and it's unlikely inflation will come from supply or supply push inflation, mainly commodities, which the Fed has little control over. And that would be a concern. If we were getting inflation from oil or natural gas or lumber or wheat, food, that would be an issue because that's supply issues, not aggregate demand issues that the Fed has little control over. Inflation that the Fed can't control would be worrisome. We're just not seeing that. If it doesn't come from supply, it comes from demand. The Fed can control that. So let's think for a sec here. The Fed raised rates at the fastest pace in history from March 2022 through today, yet the jobs market is still healthy, credit conditions are favorable, and consumer balance sheets are strong. And due to Fed policy, inflation is on a downward trajectory. Pretty good. So let's talk about the Federal Reserve in more detail. Partly due to weakness in the stock market, Chair of the Federal Reserve, Jerome Powell, was a bit more dovish in his press conference than expected. So you can see here the odds that a rate hike cycle is over increased. You can see here before the meeting, there was a higher probability that at the next meeting they were going to raise rates. The fact that this happened supported stock prices. Stocks have been up since that happened, had the best week of the year last week. In addition, odds that the Fed lowers rates in the middle of next year increased. So now investors are even pricing in the fact that the Fed may be lowering rates next year. If the Fed funds rate is at its peak, it's likely bond yields are close to peaking as well if they have not peaked already, and yields have already started to come down in the last month. Not a bad time to buy bonds where you can lock in interest rates in that 4 to 5% range. And so are we in a win-win? And this is what I meant in the conclusion. If the economy decelerates faster than expected, consumption or aggregate demand would decelerate faster than expected, and therefore inflation could also decelerate faster than expected. In this case, the Fed would have the green light to lower the federal funds rate more aggressively than is priced in. And as we can see, that does support stock markets. The Fed has more room to lower that federal funds rate than it has had in over 20 years. The stock market is a forward indicator for the economy. If the stock market falls much more than it has already in the past few months, it is a signal that the economy is slowing down faster than expected, and the Fed has done enough or even too much tightening. In this scenario, the Fed would turn more dovish than expected. This would support the stock market, essentially creating a floor in how far the stock market can go down. Alternatively, the other win situation is if the stock market continues to go up, it is because the soft landing scenario where inflation comes down and the economy avoids a recession continues to be more likely than not. So from today's starting point in markets, investors may be in somewhat of a win-win situation. And if you look at sentiment, despite what I think is a pretty good situation for investors, and that actually makes it an even better situation for investors who are objective, I think, is that sentiment is pessimistic. When sentiment is pessimistic, markets tend to do better. Buy when there is fear is the old adage. And you can see valuation here. I do think small cap looks very attractive relative to large cap stocks right now. Albeit interest rates do have a more negative effect on small caps. If we have reached the peak in the cycle and interest rates do start to come down, or the market even forecasts that they're going to come down, that could definitely help small cap relative to large cap. And you can see a history of bull markets. If we are in a bull market still and we just saw seasonal weakness, which I'm implying, then we may have a lot more room to go. Historically, the average is 86% approximately over 576 market days. We're, somewhere between 250 and 300 market days into this one. We're up only about 20%. So a long way to go potentially. And of course, always stay invested. You don't want to miss the best days of returns. Last week, the market was up 5%. If you miss that because you were trying to time, never a good thing. Stay invested, stay disciplined, stay within your plan. We have various strategies at Argent. We also just added bond SMAs as well. That's not shown here. Reach out to us. Contact at argentwm.com if you're interested. I'm Matt Rastusha, Chief Investment Officer and Principal at Argent. Thank you for listening.